Do not put all eggs in one basket. I'm sure you must have heard this a lot. I don't know how much people follow it. I don't think I follow so much. But recently I came across a mutual fund category that helps us do it, although not perfectly. It is called multi asset allocation fund. So, in this episode, I will tell you something about diversification. I will also tell you which one of these multi asset allocation funds is the best for you. Also, I'll share my worksheet with you. So, please watch this video till the end. Let me start by saying that this is not a sponsored video. This is not an investment advice. Please invest only after careful understanding of your own risk profile and also seek a professional help. I'm not a SEBI registered research analyst or investment advisor. However, I am a chartered accountant and I have worked at broking firm as an economist. So you can try hearing me out and then in the comment section we can discuss more on this. So what is diversification and why is it required? The main thing is that if you invest too much in debt, like say FD or bond, then you will be getting lower returns. But if you are too much into equities, then you will be taking a lot of risk as you can also lose a lot of money, right? So balancing is necessary. And therefore, you should not put 100% in equity or 100% in debt. There are multiple theories on how much percentage is an adequate one or the best one. The simple rule that you can follow is 100 minus age rule. If you are 30 years old, then 100 minus 30 is 70. That means 70% should be in equity and 30% in debt. So basically, it is like if you are young, you can take more risk and then you can invest more in equity. As you grow older, you need more funds for emergencies. And that's why you have to invest more in debts rather than equity. In that 70-30 rule, you can basically play around a bit and you can also choose gold. So usually out of the 30% which is in debt, people say that okay, 20% can be in debt and 10% in gold. That's how you have to balance your portfolio. Now diversification should also be seen within each category. That means within equity you can look for sectoral diversification. All investments should not be in say banking sector or technology sector. Another case of diversification is market capitalization. So large cap carry lesser risk than mid cap and small cap. Small cap carries higher risks than mid cap. And within that portfolio, there are FDs, bonds, and debentures. Government as well as private sector both issue such kind of bonds and debentures. Private sector is usually considered risky than the government, but there are enough good number of private companies in India which are fundamentally stronger than the government sector. So you can trust some of these companies too. Within commodities, you can diversify into gold and silver. Traditionally, people have been investing in physical gold and silver, but there are digital options too. So that means you can get digital gold, ETFs, and mutual funds that invest in gold and silver. Now, let us talk about multi asset mutual funds. Usually, mutual funds are categorized into three funds. One is equity, second is debt, and third is hybrid. The name suggests where the fund will be investing their proceeds into. Equity fund will invest in equity shares. Debt fund will invest in corporate and government bonds. Hybrid will be mix of equity and debt. The proportions can be upper niche. There is something called equity oriented or aggressive mutual fund where the equity component will be more than the debt component. There is also debt oriented funds where the debt component will be higher than the equity component. But there is something called multi asset funds, which not only invests in equity and debt, but also invests in commodities and other assets. I believe that at the current juncture, we should diversify more. This is because usually when we are approaching a recession and which experts are telling us that in 2024 global economy might see a recession, then debt and equity markets both can function whimsically. I believe if you are a passive investor, then these kinds of funds are better for you. Now, here's a disclaimer. I have invested in one of these. Actually, it is while doing my homework on multi asset mutual funds, I came up with a comparison spreadsheet and I will be sharing that spreadsheet with you. I hope you like it. There are around 15 to 16 multi asset schemes, but I have rejected 6. So we will be analyzing only 10 such schemes. The reason why I have rejected these schemes is on the basis of diversification percentage. I calculated how much proportion each and every scheme invests in different assets like equity, debt, commodity, etc. I've been investing in mutual funds and share markets for quite some time now, and traditionally, all my mutual funds are fully equity or fully debt, and all the equity mutual funds are usually Indian market centric only. If I want a combo, either I can choose hybrid, which has both equity and debt, or I can buy them separately. So if I'm looking for a multi-asset mutual fund, that should actually be multi-asset. That is, it should diversify into equity, debt, and also commodities or REITs. As of now, Indian mutual funds have only these kinds of assets. Crypto or any other alternative investment is not a part of any mutual fund. So for this, I calculated something. I was interested in diversifying into overseas markets and commodities, both. So I calculated how much proportion is invested in non Indian equity and commodities. For example, there is a Nippon multi asset mutual fund scheme which invests around 50% in domestic equity, 17% in overseas equity, 15% in debt, and 12% in commodities, and remaining 5% in cash. I was interested in overseas equity and commodities. So in this case, it is 17 and 12%, which is 29%. So the Nippon has 29% diversification within its portfolio. And similar calculations were made for all the other mutual fund schemes. There are 6 such funds where proportion is lesser than 15%. So I rejected them because we should have diversification, and lesser than 15% will not give that diversification. Otherwise, it is better to, directly invest in equity mutual fund or debt mutual fund. If there is no substantial diversification from the mutual fund schemes, then there is no use for such schemes. So I rejected ICICI Prudential, Edelweiss, Shriram, Motilal Oswal, SBI, Axis, and Aditya Birla because they have lesser diversification. That means we will analyze these funds: DSP, Quant, White Oak Capital, Tata, Nippon, Kotak, HDFC, Baroda, BNP, and UTI. So I have created this sheet. So here you can find out different details about each and every fund. And then here I have mentioned the rejected ones and how much diversification percentage they have. So Aditya Birla is just below 15%. So you can choose that, and you can get some information about Aditya Birla, which is written over here. So it is better to have that information in hand. So now this is how I have classified this information. So first is equity, how much proportion is in equity. Here we have PSP, Quant, WOC, and every other mutual fund. Under that, there is overseas. In overseas, you can see only three have overseas exposure: DSP, WOC, and Nippon. Then I have domestic, which is basically Indian markets. Here, all have different kinds of proportions, and you can see for yourself. Then there are sectoral weightages, then debt, then commodities. Under commodities, the classification is gold, silver, and others. Only Tata has exposure in other commodities apart from gold and silver, which is into, say, crude derivatives or zinc derivatives, copper derivatives, something like that, which is very unique, I thought. Then there's REIT, and which is also available in only three of these mutual fund schemes. So here's the diversification ratio. You can see the formula. It is overseas plus commodities plus REIT. That's how the formula is for the diversification: 29% in DSP, 38 in quant, so on and so forth. Under diversification, there's something called as non-gold MF, because a lot of mutual funds invest in gold only. What are non-gold MFs? I will deduct gold proportion from the overall diversification number. Okay, that means it will have non-gold commodities plus REIT plus overseas equity. Then non-gold commodities. It is only the commodity proportion, and that too non-gold. Only three mutual funds that are investing in commodities apart from gold. Now within sectors, a lot of mutual funds, especially the large cap mutual funds, which you generally might have, carry a lot of weightage for
financial and technology companies. And that's why I was thinking that if I want to diversify beyond that, I am calculating fin plus tech proportion, and basically whichever is lower, I will prefer those mutual funds. Then there's large cap, mid cap, and small cap proportion. Then there are returns. A lot of them are new, so you don't have a lot of data for them. Then there's something called as YTM, which is yield to maturity. So how much percent of bond yield you will receive till the bond gets matured. Here we have debt component also, so we have to think about these things. YTM, higher is the better. That's the easiest thing that you can think of. Then there are some ratios. Turnover ratio is something how much proportion of the assets are changed every month or every 2 months or something like that. Here most of them are new, and in general these type of schemes are also new, so there will be higher turnover ratio. As you can see, that is something which will not help us achieve anything as of now, I feel. Then there's Sharpe ratio. So here the funda is that we want to have higher Sharpe ratio. Okay, Sharpe ratio basically indicates how much returns you will get considering your risk. Okay, then there's expense ratio. We want the lowest expense ratio wala fund. Then standard deviation. Standard deviation, again we want lower standard deviation, because standard deviation indicates volatility. If the returns are too volatile, that kind of stuff we don't want, because we might already have something in equity funds or directly share market exposure. So at least in this kind of mutual fund, we will avoid having too much volatility. Then we are having portfolio P and PB ratio. Okay, and here's the final breakup of equity domestic, debt, commodities, overseas, others. These are the final breakup, and this is the basic charts which I have drawn. Now I know this is too much information, but what we want is in this list. Which are the most diversified mutual funds? Top 5 are these. Which are the funds having the lowest equity exposure? Which are the mutual funds with highest equity exposure? Which are the mutual funds with highest overseas exposure? Then again, highest commodities, highest non-gold MF. Now basically highest non-gold MF as in apart from gold, where else the mutual fund is investing, because a lot of mutual funds, if you see, invest some proportion in gold. It is common, but I already have some gold in, say, bonds or ETFs or physical. Then I want to invest in something else apart from gold. If that is the question, then you have to look into these things. Where else apart from gold this particular mutual fund is investing? And we are saying that these are diversified or multi-asset. So which other assets that matters to us mutual fund is investing into? So first is Nippon, where they are investing in overseas equity, which is again some kind of diversification. Then Tata, which I have already told you, invest in other commodities also. DSP invests in overseas equity. Quant in silver. WOC invests in overseas equity. And REIT, which are non-gold commodity mutual funds. So these are the mutual funds which carry higher non-gold commodity portfolio, highest REIT. REITs are not more than 3%, I have observed. So it is restricted to around 3 to 4% maximum. Then highest debt, lowest financials plus tech companies that I've told you just now. I want lower proportion in financials and technology companies. So DSP gives better kind of diversification, Quant also, and WOC Tata Nippon following them. Highest industrials, so that is also can be one of the topic that you can think of. Okay, nowadays we are seeing a lot of infrastructural boost, and if you feel that okay, manufacturing sector might grow, then this is the sector that will grow in future. If that is your thinking, then you can look at such kind of different sector wise diversification too. Here we can see that Quant gives higher industrial proportion, highest large cap, lowest large cap. So all these things are there. Depending upon what you want, you can choose something from this particular sheet and make your own list. Now here we will see lowest to highest P ratios. So right now I don't know if we have to think about P as at the moment, because markets are already very high. So if markets fall, then P ratios will come down drastically. So I don't know if P ratio will help you arrive at something or not. Personally, I won't be looking, but if you have some theory, if you have some kind of thinking in your mind, then I have just mentioned it here so that it will help you to make better decisions. Similarly, PB is also there. Then there is this particular low to high YTM and low to high maturity. These are the things that I have provided here. This is one particular chart which I feel you can think through how to understand the debt mutual fund part of it. On left hand side, you have maturity in years, and on the right hand side, you have YTM, which is yield to maturity. So what it tells us is that for Baroda, average maturity for their bond portfolio is 1.3 years. So in next 1.3 years, their bond portfolio will mature. And for that portfolio, they are getting yield of 7.2%, or they will get yield of 7.2%. That's the data they have published. Similarly, there are different mutual funds along with their own YTMs. So how to read this particular thing? Let us say in Baroda you have 1.3, and in DSP also the average maturity is 1.3. So both will mature at the same time on an average, but who's giving higher return? That is something we have to prefer, because in the same time, if I'm getting 10% from someone and 12% from the other, I will prefer the 12% wala guy, right? So here also we will prefer, say, Baroda, which is giving 7.2%. That is how you can read from one particular angle. The other angle, let's see quant, which is having highest maturity. Now usually there is a lot of complication in this, because there is yield curve, which is basically how much maturity years are there and how much interest rate that particular maturity year will get. There is some theory and a lot of things going behind it. We will not discuss those things, but let us see that for quant the average maturity is 9 years almost, right? So for 9 years you are getting 7.2. But where else you are getting 7.2? You can get 7.2 in Baroda by keeping it for 1 year only. So that is preferable, right? But here the problem is the quant guy is saying that 7.2 will be the average YTM for next 9 months. The Baroda guy does not guarantee that 7.2 will be for the next 9 years, because their average maturity is only 1 year. Okay, after 1 year they will invest in some different bonds, and their YTM can be slightly different. It can be high, it can be low, depending upon the conditions. But here, as of now, this is again not guaranteeing, means there is no guarantee in markets, but in loose terms, if I am telling you that okay, for 9 years you can get 7.2%, this can be seen as a good sign also, that okay, it is stable returns, so you might prefer quant because the maturity is longer. Usually higher the maturity, higher the interest rate, because what happens if you are keeping money for a longer term, it means that you will be carrying a lot of risk. Who knows after 7 years what will happen, right? So that's why the risk is higher, and that's why the returns are usually higher. But that does not happen in practice, and that's where the theory comes into picture, where I was telling you that there is something called as yield curve, and that's the same thing. So, but I think this is largely what you can think about this particular chart. For example, between Nippon and HDFC, you can see clear difference. The average maturity is 3.2 in Nippon, where the YTM 7 almost, and in case of HDFC, maturity is almost similar, 3.3, while the YTM is 7.6. So when we are comparing these two mutual funds, then obviously higher YTM will be preferred. Okay, so here nothing is guaranteed, or nothing will be like okay, this will only work, because market will be evolving, market will be changing, and things will be uncertain as always. So it is up to you, your professional advisor, who will tell you after looking at these things, then only you have to invest. I'm just telling you some basic funda to think about, how to think on these diversification matter and this multi-asset portfolio. Okay, similarly I have given Sharpe ratio. Highest Sharpe ratio is what we want, so even you might like DSP or WOC. So but there might be other factors that might discourage you from investing. And then lowest standard deviation, again WOC has the lowest standard deviation. So all in all, these are the things you can look into while deciding. Again, to simplify your process, I have made this particular sheet. It tells you order of preference, which ones will you buy or should buy or can buy, then their respective weights. Here we have given more debt, so that means these are the debt proportions in that particular mutual fund. Basically 26% in WOC, 15% in Nippon, 15% in Quant. That's the debt proportion of these mutual funds, and what is the equity portfolio in these mutual funds. So this is how broadly I have made this sheet. So let's go one by one. If you want more diversification, then this is the order, because the diversification percentage which I've told you, less equity exposure, then these are the order of preference. Then there's mutual funds with more debt, then mutual funds with other commodities, REIT and overseas, then this is the order. Then more commodities, more non-gold commodities, more REIT, less large cap, less fin and tech stocks. So it is nothing but a representation of this particular sheet in a different manner. It will help you in understanding it more comprehensively. So again, there are risk and return kind of things I have mentioned: low PB, low PE, high PE, high PB, higher Sharpe ratio, and lowest standard deviation. So all the things are over here, and you can have a look at these things. I think that this is a good kind of ready-made sheet that you will be getting for deciding where to invest and how to invest. So my personal choice will be investing in Quant, WOC, Nippon, DSP, and Tata, because these are the top things I have found out because of different reasons, and you can see why I am choosing those things. Diversification, maximum diversification is provided in these three. Then less equity exposure is provided in DSP. Again, DSP is one in this, and this Tata is also good for more non-gold commodities. So that's why I feel these are the top 5 mutual fund schemes from the multi-assets. So let us have a quick recap of the top 5, which is basically DSP, Quant, WOC, Tata, and Nippon. You can see that overseas investment is available in DSP, WOC, and Nippon. In case of debt, higher debt is available in WOC. In case of commodities, a higher commodity exposure is with the Quant, but higher non-gold commodity exposure is with Tata. REIT is available with WOC only. So this is how I feel you can use this particular sheet and make your own changes. Maybe we can discuss this on comment section, and let me know if you need something else from multi-asset mutual fund schemes. And if you find this interesting, share the YouTube video link as well as the Excel sheet with your friends and families and colleagues too. And let me know if you need anything else. I'll be happy to help you. Thank you. See you then.